The most common question any new investor face in their life is that what to select, whether it is an ETF or a mutual funds. When they go to the bank tellers are always busy in selling their own bank's mutual fund because they have some commission to get, they have some sales target to meet. And on the other hand, when they see some YouTube videos content creators, they are promoting ETFs for some reasons. And in this chaos, the new investors always feel confused what to select. If you have the same confusion, this video is for you. My name is Mayur. I live in Canada, work as an engineer, but I love to make videos on personal finances. This video is all about mutual funds versus ETFs. And I can totally guarantee you that if you watch this video fully, you won't have to bother anybody else about your next investment purchase. And you won't have any fear of losing your own money. So let's start it. Now let's see how does both works and what is the basic difference between them. So to tell you the difference, both mutual funds and ETFs, they allow us to invest into the stock market by buying the fractions of n numbers of different stocks from the different companies and the different sectors so that we can have enough amount of the diversity. Now this diversity depends on the different type of mutual fund and ETFs that you buy from. For example, some ETFs and mutual funds, they just focus on the gold. Some are on the silvers. At the same time, some mutual funds and ETFs, they just focus on the tech companies. For example, VF ETF, that is a very popular ETF in the North America. This ETF invests into the top 500 companies across the US, and that we call as the S&P 500. Similarly, some mutual funds from the bank, they just have their own portfolio. Overall, the whole mutual funds and ETFs performance depends on the stock market performances itself. And which stock to include in the mutual fund or the ETF is decided by the fund manager. These mutual fund companies generally hire a fund manager who will decide which stocks and which companies to include in the particular ETF based on his own capabilities. So we can say that whether you invest in the mutual fund or an ETF, it ultimately depends on the stock market. If the market goes up, your result will be a little bit higher. If the market goes down on a particular day, you will be in somewhat loss. So if the market goes down, it will be a win-win situation for everybody. But let's say if the market goes down, no matter what label you have in your portfolio, whether it is a mutual fund or an ETF, its total dependent will be on the stock market. And also it will depend on the stocks that you have in that particular portfolio. To put it in a simple way, buying a mutual fund or an ETF is like going to Las Vegas. We want to go to the one destination, but there might be the two different vehicles. One is the government transit bus and the other one is the private cab. One is little bit slower, cheaper and effective, and the other one is little bit costlier, and you will have to pay the full price even if you get off midway. In this segment, we will see the three most basic differences between mutual fund and ETFs. Well, I have derived these differences while reading some questions on Reddit, and I thought that it would be a good idea to incorporate this into the video. So the first is how to buy a mutual fund and ETF. Let's talk about the mutual fund first. Generally, the mutual funds are the product from a bank. So let's say if you want to buy that particular mutual fund from the bank, you will have to go to the bank, schedule an appointment from the busy schedule, open and trading account from that particular bank because that mutual fund is only available through the bank itself, and the maintenance cost in order to operate the trading account is comparatively more higher. In Canada, it is almost $10 every month so that you can buy mutual fund whenever you want to. On the other hand, ETFs are the very simple to buy. Open a brokerage account for any financial institute, search the ETF that you want to buy, load some money in your trading account, buy ETF. Simple and period. Now I'm in Canada. I love investing in ETFs because of certain reasons that I will be talking into the next segment of the video. And at the same time, I want to pay at least no fee or the zero fee for the maintenance of the trading account. And for that reason, my favorite is Wealthsimple. I have been using Wealthsimple from almost 1.5 years, ever since I started my investing journey in Canada. If you want to open a Wealthsimple trading account where you can buy your ETF stocks at zero commission costs, the link is in the description box. If you open an account through the link in the description box, Wealthsimple will give you free $25 to start your investment journey. So what are you waiting for? Just click on the link and open your investment account. And if you have any question, make sure you comment into the comment box. I will try my best to answer that comment. The second difference that plays a very crucial role in deciding what to buy, whether a mutual fund or an ETF, it is the cost of buying that financial product. Now both mutual funds and ETFs, they both have some associated fees with them because we are hiring a manager who will decide what to have in our portfolio. So we need to give some fee. But the difference between these fee percentages is massive. ETFs are comparatively less fee chargeable when it is compared to the mutual fund. Mutual fund and ETF, they both have two common fees, the expense ratio and the exit load. For the ETF, the expense ratio might be in the range of 0.05 percentages to 0.025 percentages. And for the mutual fund, that number varies from 1 to 3 percentages. In the beginning, these numbers looks very smaller, but when you calculate its total cost associated if you want to invest for a longer term, let's say 25 years, you can't imagine how much amount of the fee that you will be giving to that particular institute. And that's why I always say that for the next 20 to 25 years, if you are going to invest, it is not the market crash that will affect your wealth, but the fees that you will be paying to this finance institute will lower down your wealth by the significant amount. Think about this. In 2021, the minimum wage in Ontario or Canada was in the range of $5 to $6 an hour. In 2025, after 25 years, that number was around $17 to $18. That is nearly 150% increase in the economy. So over the period of time, the economy will increase. Whether it's a mutual fund or an ETF, this bold performance will be increased in 25 years. But what makes you take home more is the total fees that you'll be paying. Let's understand this with a very simple example. Assume that you are investing $25,000 in ETF and another $25,000 in a mutual fund in the next year. Let's assume that the overall return on these two financial products after 25 years will be 8% every year. What do you think? What will be the total amount of fees that you will be paying in this ETF and mutual fund? To be precise, if you buy a low-cost ETF who charges around 0.1% maintenance fee, you will be paying around $4,000 after 25 years as the fee to have that ETF in your portfolio. But if you see the same number for mutual fund having a management fee in the range of 2 to 3 percentages, you will be amazed by knowing the number. You will be paying more than $65,000 as a maintenance fee just to have that $25,000 of investment in your portfolio for the next 25 years. Just by choosing a high fee mutual fund, you just did not pay the small percentages of fees, but you actually handed over your own $65,000 to the bank absolutely for free. And $65,000 is more than the double your initial investment, that's your $25,000. You did all the work, you took all the risk, but bank cost you $65,000 for this, just to suggest which stock to invest in your portfolio. This is the basic difference between buying a mutual fund and the ETF. Most of the people who buy mutual funds through the bank, they are like flying blind. They do not even check their holding at least a couple of times in a year. And in fact, most of these investors, they do not even know where the bank is investing their money. They just sign a paper because somebody from the bank told that, hey, it is a very good mutual fund to buy. But on the other hand, ETFs are very different. They are very transparent. In fact, if you search VOO or VFV ETF that I talked about in the previous segment, you can see on the website that which different stocks is held by that particular ETF, even which different stocks, which different sectors, and by which different proportions in percentages. But here is the truth. It does not mean that always more information will lead you to the better decisions. And in fact, for the long-term investors, too much information sometimes act like a noise. The one and only person who get really benefited from the real-time, second-by-second data is our broker, who gets brokerage when we do some trades. For us, transparency becomes the noise the moment it starts affecting our emotions. And if you talk about control while deciding what to buy, a mutual fund or an ETF, it is not about deciding which stock to buy. It is not about deciding which mutual fund or ETF to buy. It is about controlling your magic number. The real control is that to know what number of the minimum investment that you need to do, and you need to decide that number. Not the bank manager is telling you that you need to invest minimum of this amount. For me, this magic number is 30% of my total income. I invest 30% of my total income every month without any doubt. For you, that number might be 10 or 20 percentages. You want to be the pilot of your plane. You do not want to know about all the bolts in your plane. You just need to make sure that you are in the right direction. So we talk about a lot of different factors that you can decide while buying a mutual fund or an ETF. And you would have kind of got some hint that I am more of an ETF person. But then the question is that why most of the people still want to go for the mutual fund. So let me answer this very honestly. If you are a beginner investor and do not want to use your own judgment and prefer to appoint a fund manager for yourself, I would say that you should go for the mutual fund. Just go for that. It will be well managed by the professionals rather than you end up investing nowhere. And to answer the questions fully, people generally do not like changes in their life. Once a person subscribes to a particular mutual fund in the beginning, they generally do not put extra effort to find something better. They just keep investing in that particular ETF until and unless somebody advises them or they learn investing by themselves. And this is how these people become disciplined without even realizing. And if you are disciplined, market boom or the market crash is not gonna affect your emotions. You will be keep investing the same amount of money that you have decided when you sign the paper to buy that mutual fund. And we all know that market crash is not gonna last forever. So in particular those situations, your buying average price will be little bit lower, and that will help you when you sell that mutual fund. So whether it's an ETF or a mutual fund, if you think that it is boring for you, totally understand that it is simple and the right product for you. Because I always say that we want to keep our investing journey very simple and boring so that it is very easy to follow. If you make it complicated, it will be too much harder to solve, and even you might end up stopping your investment journey in between. So don't do that. So in the end, only two things that can help you build your wealth successfully: consistency and patience. Do not ever think of having fear of missing out. Because let me tell you that in the last 25 years, on an average, market has given return of 7 to 8% every year. So keep investing at least 20 to 30% of your total income in whatever mutual funds and ETFs, whatever you like. Everything is good. Because people often regret from the wrong behavior, not from the wrong product. And one good thing here is that none of the mutual funds or an ETFs is a wrong product. It is just the wrong behavior that will affect your future wealth. Either you stop investing or you withdraw your money in between. If you are not investing, start investing now. Even if you have low salary, start investing at least $1 every day. Aim to invest $100 after you are consistent on $1. And in that try, you will end up investing $10 every day consistently. This is how you build your consistency in the investment. There are a lot of technical differences between mutual funds and the ETF, but at the longer term, they both make you reach at the same destinations. So do not overthink, just start. And if you have really liked this video, make sure you appreciate by subscribing to this channel. This will really help me. Until then, thank you so much.